Welcome to the AWA Market Minute, breaking down financial, political, and economic events that impact today's retirees. Our investment committee performs hours of research and market analysis every month so that we can share simple summaries with our clients in 30 minutes or less. Featuring top industry experts who share insights on important topics so that our clients can gain understanding and peace of mind on their journey to and through retirement. And now your hosts, Chief Investment Officer Scott Hoxer and Founder and CEO Paul Coles.
Well, hello everyone. Hello and welcome to this month's edition of our AWA Market Minute. Super excited to be with you all today. I'm Paul Coles. With me as always is Scott Hoxer. We're excited to introduce our guest host in a moment. Scott, we had some kind of terrifying events take place recently, and I think we're all kind of in shock and awe as we're watching some of these things unfold and on the edge of our seat waiting to see maybe what's going to happen next.
Yeah, no, super disturbing and really difficult to watch. And, our hearts, certainly go out to those folks. And yeah, I know it's been, a challenging couple years as far as, some of the data and the news that has been coming through. And, this is another data point that, impacts markets. Impacts
economies, and the geopolitical uncertainty, both domestic and abroad, it can cause a lot of emotional concern for our clients, rightfully so.
Absolutely.
Yeah.
Absolutely.
And I think now more than ever becomes such an important plan to say we have an all-weather approach to how we intend to move forward through these uncertain times. We don't want to move forward guessing. We want to move forward with a high degree of confidence that the approach is designed for an all-weather situation. We've got here in Utah snow falling once again, and the seasons change so rapidly here from what seems to be summer to fall to winter. We really do want to have something designed, when you're driving a vehicle that can get you through all those seasons at a moment's notice. And that's where, the analog to smart retirement matters to our clients. We want to give them a situation where when they're, in retirement and they're traveling abroad or whatever it is they're doing, and we catch these headlines of what's going on in the world, they're not in a position to say, what do I do next? How do I react and respond to this information? They're in a position to say, I've already made plans for this. I've already made, my retirement portfolio designed to go through this kind of experience. And smart retirement gives our clients that peace of mind amidst that turmoil.
Absolutely. And we don't always know what the next headline is going to be. We had no, intimation that what was going to happen in Israel was going to happen. But we do know that turbulence will come. And so the time to kind of address turbulence isn't in the moment. The time to address turbulence is, a long time ahead of that. And again, we don't know what's going to happen always in the future, but we can prepare for most contingencies.
Absolutely. Yeah, and that's well said. And just having the right tools already, lined up to be able to deploy at the appropriate time, rather than trying to go back and invent something after the fact. We can't do that. And so as we go through, just by way of repetition is the motor of learning, smart retirement, giving us the ability to, dynamically put our investments into multiple asset classes, and we break them down in very elementary formats so that everyone at home can follow a common language, and we call them our spending bucket and our protected bucket, our defensive bucket, and our growth bucket, with each bucket having a different objective and goal and strengths and weaknesses. Frankly, each bucket isn't going to be all things to all people at all times, but they have moments where they really begin to shine, and their utility begins to be evident during different periods of market volatility. And so today we want to talk a little bit about the economy and how it impacts the overall investing landscape. But just keep in mind as we have this conversation, we have these plans in play for our clients with Smart Retirement to give them the opportunity to say, this is going to impact our red bucket. It's going to have some impact on our yellow bucket. But when it comes to our green buckets, this really won't have any kind of direct correlation to those buckets. When it comes to our gray buckets, it won't have any direct correlation to those gray buckets. And the idea behind the design is that all-weather approach. So with that backdrop, Scott, why don't we go ahead and introduce our guest host today, and we'll talk about markets and economy and what's going on.
Yeah, thanks, Paul. So we have a tremendous guest today, super credentialed, very, very knowledgeable about all things markets. So we're being joined today by Tim Holland, and Tim is the Chief Investment Officer of Orion, which is a multi-billion-dollar investment platform. Tim has over 20 years of investment experiences kind of throughout the financial services industry. He's been a portfolio manager, hedge fund analyst, and is a CFA charter holder. And Tim's investment commentary can be found on various business media, including CNBC, Fox Business, Bloomberg TV, The Wall Street Journal, Investment Business Daily, and others. So very credentialed and impressive guest. And Tim, thanks for joining us today.
Yeah, no, it's great to see you, Scott and Paul, and always a lot of stuff to talk about, particularly now with, to your point, the horrific events overseas. So it's nice to see you. I'm glad you're all doing well, and I appreciate the invitation.
Yeah, thank you, Tim, for being with us today. And just on a personal note, we just think the world of Tim. He is somebody that we lean on heavily for being an expert in the subject matter, and so as we kind of go through these questions today, we appreciate your expertise.
Thanks. No, happy to be here for sure.
So Tim, let's maybe start with perhaps some of the difficult stuff first. Obviously some difficult news to consume and digest over the weekend. But let's talk about kind of how those events in Israel impact markets. What are you seeing kind of here in the near term, and then what are some potential intermediate term impacts?
Yeah, no, it's terrible what's going on over there. And for anyone who has friends in that part of the world, relatives, I hope they're all safe, and I hope they can get out of there if they need to get out of there. It's terrible. That all said, and at the risk of coming across a little cold-hearted, because the events are so horrific, to sort of step back and think about the economic and the market impact, because that's what we get paid to do on a day-to-day basis. In terms of the short term, Scott, what's happened the last couple of days is what we thought would happen as these events started to unfold over the weekend and then into the week. The first was that oil would spike a bit on just sort of that geopolitical dynamic. Obviously, Iran is involved in all of this, at least via proxy, Hamas and Hezbollah. And they are a major oil producer, even if they don't export much because of still existing sanctions. They're sort of a nominal player on the export market, but they're a participant. And obviously that part of the world is responsible for a tremendous amount of the world's supply. So we thought we'd get a spike in oil. You got that on Monday, where it was up $3 or $4 a barrel, both here at home and overseas. And though that's come in a little bit, which I think is encouraging. I think the market's starting to see through some of these events, as terrible as they are. The other thing we thought would happen also happened. On Monday, our bond market was closed for Columbus Day. But we thought once the bond market opened, U.S. bonds would as they say in our business, right, catch a bid. People would want to own U.S. Government bonds. And you saw that the last couple of days, a little bit of a sell-off today, because even with all of our problems politically, there's a bit of dysfunction still in D.C. We've got our issues around inflation and the economy. We're still, as some people like to call it, the cleanest, dirtiest shirt in the hamper. Yeah. When the world gets really scary, people want to put their money with our government and in our markets. And so you've seen that. And I always take that as a huge vote of confidence, again, especially when the world's unsettled, or maybe when the U.S. as a country politically isn't sort of putting its best foot forward. I always take a lot of comfort when I see our dollar rally and our bonds rally. So we've seen that.
And
over the. Go ahead. Sorry.
I was just I find that fascinating, Tim, and in some weird way, like you said, comforting. There's a degree of solace in that, knowing that this has been a historical precedent that we've seen time and time again, as the world turmoil turns up, and there's this degree of anxiety. There is a flee to the dollar. The world kind of comes back and says, okay, that's the safest place we know of to kind of shelter.
Yeah, for sure. And
I was going to say, as the old Mark Twain, the rumors of my demise have been greatly exaggerated.
Greatly exaggerated. No, it's
a lot of news and kind of ink spilled over the demise of the U.S. dollar, and in times of crisis, that's just not the case. So there's still that flight to safety.
Yep, for sure. And so when the headlines are particularly overwhelming and particularly confusing and frightening, that's where I'll go, right? And I'll sort of say, okay, with all the money in the world, able to go anywhere in a minute, and the world, to Paul's point, is particularly unsettled right now, where is it going? And as long as that dynamic is playing out under the surface, and it can be hard to focus on it when there's so much turmoil in the world, that is a point of comfort. And if we ever get to a point where that doesn't happen, then I'll be a bit more concerned. But as long as that's the default, gosh, if that doesn't create a lot of comfort for me, not just as an investor, but just as an American. So that's played out the way we thought it would. In terms of the intermediate term, and I'd love to hear what you think, Scott, and what you think, Paul. I'm making a couple assumptions, and they might be terribly naive or terribly dangerous assumptions to make. But one of the assumptions is that this conflict is not going to get to the point where Israeli tanks are facing off Iranian tanks. Iran will participate via proxy, Hezbollah, Hamas. I'm working off the assumption Israel is getting control of its borders, will go into Gaza and do what it thinks it needs to do to dismantle, if not outright destroy Hamas. There will be a lot of volatility around that and a lot of very frightening headlines, but this will not spill into a broader open regional conflict. And if that's the case, then I do think while markets may be volatile, oil may go up and down, there may be some down days to the markets, that Israel will get control of the situation, and you will go back to a certain extent a almost unworkable détente, but it's been an unworkable, unsettled détente for 75 years now, and no one has a solution, and I don't know if that part of the world will ever find a solution, but they will go back to some sort of manageable status quo, even if no one is particularly happy with that status quo, if that makes sense.
And really, well, I was just going to say, and really, just to add to that point, Tim, that what you just described is business as usual and has been like that for the last 100 years.
Yeah.
So, I mean, the status quo has never been something that's been settled out there.
No. Yeah. I guess it's an unsettled status quo is the way to think about it. And so if that happens, then I think over the next several weeks or months, it'll come back to much of what we've been focused on the last couple of years, and that's inflation and interest rates and the health of the U.S. consumer, and where markets go into year end. So that's our construct. I do think one other impact that the events in the Middle East could have here at home is obviously in Washington, D.C., the big news before the horrific events in Israel was the fact that we didn't have a Speaker of the House. And we have an interim funding deal to keep the U.S. government open to the middle of November, about a month from now. And there was real concern that, okay, who's going to sit in that chair? And also, will Congress and the administration be able to reach some sort of spending deal, either longer term or at least to kind of kick the can down the road for a few more months? My personal opinion, and again, this may be naive or off base, is that the volatile and very frightening events in the Middle East act as a catalyst for the Republicans and Democrats, even if they're terribly far apart on policy, to kind of get something done, to get aid and support to Israel and probably Ukraine as part of that package, which has been a big sticking point. So I do think maybe I hate to use the word benefit, but an ancillary impact from all this, I think, is it gets us to a solution in DC sooner than later, just because the world just reminded us how unsettled it can be at times. So just a thought.
No, I think that it underscores that idea that when there's chaos externally, this country does tend to rally to the cause, and that's as horrific as these events have been. That's one of the outcroppings can be that this nation starts to say we need to maybe stop being so divided on some of these issues and finding solutions to coming back together again.
For sure.
And I like that summary, Tim, and our thesis and our thoughts are very similar. And as far as, Iranian involvement and escalation there, we kind of assign that a low probability, high impact type event where, if we were to handicap it, maybe there's a 10 or 20% chance that does escalate to something more severe. But one of the challenges as an investor is there's always kind of those low probability, high impact contingencies out there. And so if you kind of lean into that too much, boy, you miss out on a lot of market opportunity.
Yeah, and those scare. So I think I would agree with your thinking on that for sure. And those potential events tend to present themselves unexpectedly in a very intense, often very short time frame. And so the impulse is to do something. It dissipates, the risk goes away, and you find yourself terribly off sides, which, back to your earlier points about diversified portfolios and bucketing your money, understanding what you expect the different buckets to do, is a great way to, I think, sort of mitigate the emotional angst that events like the ones we're seeing today can cause all of us as investors. And
one of the challenges I think that today's consumer faces when it comes to understanding information and the markets and trying to make sense of all this is, there are talking heads out there whose sole goal is to sell fear because, if it bleeds, it leads. If they can get you to click, if they can get you to listen, then it can drive their audience and they sell fantastic ad space. Buy gold. If you don't buy gold, you're crazy. And that stuff's out there in front of our clients every day. And so every time there's one of these events that Scott refers to as kind of this low probability but potentially high impact event, I mean, there's no shortage of that out there. We get reminded of these potential crises every few months, it seems like. And so we do have to help mitigate a client's emotions when they get through this stuff, and it gets tricky. And we're reminded of these events, and it becomes forefront. And I like how you put that, Tim. If we don't have a good plan in play, we'll find ourselves offsides as the event dissipates.
Yeah. No, there are people that will prey on that anxiety and fear for sure. And at the risk of jinxing it, and again, not to sound too dispassionate about the events overseas, since Friday of last week, the S&P is up over 2%. Right. So it's kind of interesting, again, what the market is looking through relative to what some of the headlines are. And I know they're awful, but also to your point, Paul, what some people are particularly trying to sell at a point of distress. And usually you don't want to buy what they're selling because, again, you're going to end up in a bad spot long term for sure. So.
Tim, in terms of, I like this thread because we have seen, last 4 or 5 days, we have seen some positive movement in the market. Through about the end of July of this year, it felt like we'd turned a pretty significant corner and markets were looking pretty good. August wasn't a good month. September was a pretty ugly month to be candid. What caused that kind of late, August, September pullback in your opinion?
Yeah, in my opinion, it would be the sell-off in the U.S. bond market and the rising in bond yields, right? As we all know, if a bond goes down in value, its yield goes up, and if a bond goes up in value, its yield goes down. So, in the back half of the summer, the yield or interest rate on the U.S. 10-year note, and the U.S. 10-year note, as we know, is a note that the government sells on a regular basis to domestic and overseas investors to finance, the operations of the government, particularly since we spend more than we take in. That's where the deficit comes in. And so if people are, worried about inflation, worried inflation maybe hasn't been whipped in that environment, bonds will probably sell off. And we can get into the weeds on that. And the yield or the rate on the bond will go up. And when we came into August and September, to your point, Scott, it was a really, really rough couple of months for the market. I think the S&P 500 was off over 7% or so between the two months in total. I really think it was the yield on the U.S. 10-year note going from really the low fours to almost 5% as people started to think two things. I think one, inflation is maybe a bit more persistent and the economy is a bit stronger than we thought. And the Federal Reserve, our central bank, met in September and they came out of the meeting and they didn't raise rates again after raising rates 11 out of the last 12 meetings, and the market didn't expect them to, but they talked, as we say on Wall Street, in a very hawkish manner, saying that rates were going to stay higher for longer, and in a way that spooked and surprised the market. So I think as bonds sold off and yields moved higher, stocks sold off in sympathy because I think people were worried that the Fed might be hiking rates more than they thought or keeping them higher for longer. And ultimately, high interest rates are going to be bad for the economy, bad for economic growth, and something that the stock market doesn't like. So I think that was the biggest driver of the downturn in the market in August and September.
On that note, Tim, you mentioned bonds and kind of bond prices and the relationship with yields. I know a lot of investors are feeling pretty burned by bonds right now. If you look at long dated Treasury bonds and what they've done over the past couple years, it's been staggering to see for a kind of safe investment like a bond to fall as precipitously as it has. Some people are questioning and saying, hey, should I still own bonds in my portfolio? And they do feel a little jaded by kind of what bonds have done. What would be your response to that question? Should I still have bonds in my portfolio?
Yeah, so the short answer would be yes. And if I could jump to slide 32, let me go there for a second. So hopefully you all can see a headline, what if the Fed isn't done yet, right? And so on the screen, the light blue line is the yield on the US 2-year note, and the darker line is the yield on the 10-year note. And so you see for the longest time, we'll just focus on the darker line, that the 10-year note gave you a coupon of about 2 to 3%. Over through sort of the 2010s, through the last decade. It kind of bounced around from 1.8 to 3 and change. And then you see yields go to zero when the Fed cut rates to zero during the pandemic. And then they've slowly moved higher and then skyrocketed. And part of that skyrocketing to the right was when the government, for better or for worse, pushed all that money into the economy 2-3 years ago, and then tried to open up the economy, and we got all that inflation because there was too much money chasing too few goods in an economy that was overwhelmed, right? We all remember going to the grocery store and seeing empty shelves and things like that. And then the Fed started to raise rates to try and control inflation. And so you got into the late summer, and there was concern that, again, the Fed maybe hadn't done enough, maybe inflation was hotter than expected still, and you had that rough August and September. To come back to the question, right, how do I feel about bonds? I'm a big believer in bonds. Now, if you're younger, you probably want more equities, more growth assets, stocks in your portfolio than bonds. But I like bonds because bonds are the only really traditional offset, the ballast to equity exposure. Now, the last couple of years, bonds haven't done great, right? Even high quality bonds have sold off a couple years in a row and are down again this year. There are a couple reasons why I think the world's going to get better for bonds going forward. One is if you look at bonds, high quality bonds as an asset class, they're slightly off year to date. Were they to close the year down, it would be the third year in a row that bonds had produced a negative total return, which is hard to deal with for sure, but that's never happened in the last 100 years. So if we get to the end of the year and bonds are still slightly in the red, and they're only slightly in the red right now, the sentiment around the asset class and the historical performance would be really set up well for bonds to do better going forward. The other thing I would say is the yield that you can get, or the coupon you can get from a bond when you buy it, matters. So during the worst of the pandemic, if you bought a 10-year note from the government, you earn less than 0.5% for each year you own that note. And so I don't know about you, as much as I love this country, I don't know if I want to loan money to the government by buying a 10-year note and earning less than 1% for 10 years. And so buying bonds 3 years ago when they offered next to nothing in the way of interest was a really bad idea. And unfortunately, those bonds haven't done well. You fast forward to today, if you're willing to lend the U.S. government money for 10 years, you're going to get paid over 4.5% per year, risk-free, unless you think the government's going away, and you're going to get your money back at the end of 10 years. And if you think inflation has peaked, and I really do, I really think we're on the other side of it, those bonds are going to do even better. So it's been a rough stretch for sure. The possibility that the next 2-3 years look like the last 3 years would be unprecedented, and you're jumping off or buying a bond today in particular at a really, really attractive rate, where that was not the case for much of the last 3 years. So
And Tim,
hopefully that's helpful.
When you said, I think those bonds are going to do even better, let me just maybe add some context there. So as interest, when you're saying we're at the top of the peak of the rate cycle, as interest rates cycle back down the curve, those bonds will market value adjust and appear as even more attractive on the market.
Yep, right. For sure. So as we know, Paul and Scott, if a bond is out there today that offers a coupon or an interest rate of 4%, and all of a sudden the next bond that's coming out is going to offer a coupon of 4 or 5%, higher, so it's a higher rate, then the bond that's already in existence is going to sell off a little bit to reflect that. At the same time, if the bonds that are coming to the market over the next couple of years are offering a lower yield or a lower coupon, and I think they will, because I do think inflation is rolling over, then those bonds on offer today that have a higher coupon are just going to be that much more attractive.
Yeah.
And as those bonds trade, investors will gravitate towards those bonds.
And I think this just maybe underscores the point that we don't want to chase the hot dot when we talk about constructing a portfolio. Oftentimes people will look at last year's performance or 2 years ago performance and say, I don't want to own that asset class based on the recent performance. And we have to, let wisdom prevail here, which is, we don't chase the hot dot when constructing a portfolio. We look, Wayne Gretzky said it right, you can't chase the puck. You have to skate to where the puck is going to be anticipated next. That way you can always be in the action. And that's obviously kind of this conversation.
Yeah. So I think that today's a really attractive moment in time to own just good old high quality fixed income, both U.S. government bonds, and then among the stronger the bonds issued by those stronger, bigger companies like the Apples and the Pfizers of the world. I just think high quality corporate bonds are really attractive too, because those bonds have suffered just like government bonds because of the interest rate environment. So I think it's a really good time for fixed income, or it's about to be after a really, really tough 2.5 years.
Yeah, and just to maybe, reinforce that concept of not chasing the hot dot, it requires some intellectual flexibility, because usually in life, what's been going well continues to go well. If you have a great football team, they're a great football team for a long period of time. You don't say, hey, the football team that was last in the standings is going to be first in the standings next year. But with investing, we often see that, where the thing that was at the very bottom is now at the top in a subsequent year. So I think that's an important principle of investing.
We might just have time for one more good one.
Yeah. So Tim, let's maybe wrap up with kind of your outlook and maybe some of the positive things that you're seeing out there in the market for the next 3 to 6 months. What are some of the positive tailwinds you see for the market?
And I'm going to go looking for another slide. I want to be sensitive to time, but also to your point about sort of you think what worked well will continue to work well. That bias that we all have. I'm a New York Giants football fan, and I was pretty excited after last year, and not so much this year. They gave Danny Dimes a lot of money, and I like Danny Dimes. He looks like a superhero. I mean, he's got the jaw and the handsome, and oh man, it's been tough.
Yeah.
All right, I'm going to try and go back a couple slides. Okay. So to come back to this question about sort of while we're all long-term investors, near-term thoughts on the market. Hopefully everyone can make out the chart on the screen. And so, past isn't always prologue, but the S&P 500, the index that I think most of us pay the most attention to track U.S. Market returns, has an interesting seasonal pattern to it. And so going back 70 plus years, if you break the index down and the returns of the index down by month, you see that August and September are pretty rough months. And September in particular is by far the worst month for the S&P 500 on average over the last 73 years. And obviously September unfortunately lived up to its reputation in 2023 after a tough August. So there are lots of adages in our business, as we know, and one is sell in May and go away. That May, June, July, August, September, and even October aren't the greatest 6 months. But when you get to November, you're kind of off into the races. So sell in May, go away, and then November through April have historically been pretty good months. So I think just based on seasonality that October, which is off to a good start, is the start of a 4-month stretch that historically has been very positive. October, November, December, January, December being the best month for the market over a long period of time. So I'd say the calendar is in our favor. I also think that September and August were so unpleasant and volatile that a lot of investors have become pretty cautious. And so as we know, a sentiment's a contrarian indicator. When people are really optimistic or enthusiastic, you want to be a little cautious. When they're pretty down in the mouth, you want to be a little more optimistic. I think that's a good lesson as we go into the fourth quarter. And I also think the pullback in the market has made everything a little more attractively priced. So I think if the Fed is just about done raising rates, inflation is going to continue to come in a little bit. You take those two things with the seasonality of the market, at least the historic pattern, people being pretty pessimistic after a tough 2 months and now these awful events in the Middle East, and corporate earnings season about to kick off, and I think that's going to be okay. We're pretty optimistic on the market into early 2024. And I know we know this, Scott and Paul, but it's kind of hard to remember sometimes that the S&P is up about 14% year to date, even with all of the awful events of late and all of the challenges corporate America has had to face this year, including the Fed raising rates and including still sticky inflation earlier in the year. So we're pretty optimistic as we kind of look through that January, February period of 2024 from today for sure.
And I think that speaks to the resiliency of our nation and the economy.
Yeah.
When we've had to endure some of the challenges that we've endured this year, and we can still look back and say, year to date, the benchmark that people tend to follow is north of 14%. We need to check our emotions sometimes and say, okay, there's a plan in place. We have a roadmap. Let's not get too emotional and deviate too far from that roadmap by way of reacting to every impulse that we might feel when fear strikes. That's how we find ourselves offsides pretty quick. And I appreciate, that sentiment there. That's probably a good place for us to wrap it up. Tim, we appreciate you taking some time to be with us today. Our clients always appreciate the expert opinions and the subject matter that you share. And Scott, any parting comments?
No, thanks again, Tim. Really appreciate it.
Thanks so much, Tim.
Yeah.
We appreciate you. And until next time, thanks, everybody. Take care.